GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's fighting inflation harder than your paycheck. I'm your host, Jay Hamilton, and today, Trump announced 25% tariffs for Canada and Mexico. Gold hit an all-time high. What does that mean for Bitcoin? The markets are more volatile than my kid playing with a yo-yo, and it is stressing me out, and I know it's stressing you guys out. So to give us all some peace of mind, we brought in one of the best in the business. I'm talking about Cem Karsan, founder of Kai Volatility Advisors. And you might know him as Jam Croissant on X. Now, Jam's 26 years of market experience have made him capable of calling multiple tops and bottoms, including the recent NVIDIA top. As a result, people often think he's a time traveler. Maybe we'll ask him, is he actually a time traveler today? Before we jump in, guys, please subscribe to our channel if you're not already subscribed. It is a huge help to us and only causes you one click. If you subscribe, we're going to make sure you stay on top of everything going on in the markets every day. Before we jump in and hear from Jem, we just need a moment to hear from our sponsors. Meet Odos, the DeFi aggregator that makes your token swap smarter, faster, and a whole lot easier. Tired of trading like it's 2019? Odos finds the best prices for your swaps across 900 liquidity sources and 14 blockchains, so you always get more bang for your crypto buck. Whether you're swapping, setting a limit order, or just avoiding gas fees like the plague, Odos has you covered. It's like having a genius trader in your pocket, minus the coffee addiction. Join 3 million wallets already using Odos to power over 6 billion in monthly trades. Start making smarter swaps today at milkroad.com/Odos. Jem, welcome to the Milk Road Show.
Good to be here. Thanks for having me, man.
Yeah, man, really excited to have you. Okay. I feel like I need to ask you if you're a time traveler because I just set that up in the intro. Are you a time traveler?
I cannot confirm or deny time travel. No, but no, I just live in the matrix. So I haven't been to the future, but when things align, you can often see the future. So
okay, well, that's what we'll try to get an understanding of today. Okay, so let's just start with 100,000 foot view. What's your take on the current market? Where are we now?
Oh, wow. So depends on your time spectrum, right? And I'm very much a zoom in, zoom out guy because cycles happen over 100 years and 20 years and 4 years and 1 year and 1 month and 1 week. So where are we now? Depends what lens we're using, but let's start with a smaller lens. First, not only did Trump announce tariffs, but it's been a 2-week breakneck kind of announcement of thing after thing after thing, right? And that's not a surprise, right? If we zoom out a little bit more, these things that are being announced, tariffs, et cetera, these populist policies are something that we've talked about for 5 years. And Trump himself is a vehicle for a much bigger generational push towards fairness. And it's really driven by probably a lot of your viewers and people of this generation. They can probably relate to a great extent that the system for really 40 years, probably all of their lifetime, right, has been stacked against them. People have had a hard time moving out of mom and dad's basement, have had a hard time paying for their college education, affording that home, all the things. And that is specific to this period. It is specific to that generation. And favoring that fairness or justice or equality over other ideals is specific to this generation in this period. Not specific in the grand scheme of things, like not in over 1,000 years, but specific over the last, I would say, 60, 80 years. And that's not going to stop or end because your generation is the one driving the future right now. And so Trump, much like Bernie Sanders and AOC and left or right, this is not a political argument, is a vehicle for that angst, for that burn it down, start over, and make it fair, right? So, and he has come to power on the back of that. But understand that he didn't create that populism. He didn't create the when his first inauguration speech was about the rusted out cities in Middle America, right? The rusted out cities in Middle America created a generational angst, and that's also driven the creation of Bitcoin, which we can dive into. It's driven so many things that have been coming now for a decade. You could have watched it and seen it. If you were watching carefully, if you understand history and what's happening, you could see this coming, and it's not about to end. So where are we now? That's where we'll start. But again, we can keep zooming out, and there's a big picture of which this is a pixel, and everything is flowing. Again, not always exactly day to day in that direction, but that is the broad thrust of where we are and where we're going.
So if we take that view of the current state of, really humanity and what we need and want as a people, and we turn our lens and we look at the markets, and we're in a very interesting market where, and a lot of listeners, and all of our listeners, Jem, we're high risk investors being in crypto, probably the highest risk investors, even if our listeners don't really realize this. If you're an investor in crypto and that's your primary asset class, you're probably the highest risk investor on earth. That's so what that means is we deal with a lot of volatility every day, which is very stressful. And my gut says that we got a lot more volatility to come, and that we're just sort of getting started, that this next few months, even through this next year, could be, a lot of people are feeling like it's going to be a great bull run, and hey, we're just getting started, and we're going to keep going throughout this year. But tough to tell, tough to say. Markets are always tough to predict. What are your thoughts on the market right now and what you think in the short term? I know you don't have a crystal ball, and I know you can't time travel, as you said at the beginning, but
No, but I do live in the matrix. And I
yeah.
think the reason I say I live in the matrix is because the matrix is not two-dimensional. The matrix is all dimensions, right? And I think to think about these things properly and to really be able to see more clearly, you really need to think about things in more multidimensional and less linear ways. And I think one of the biggest problems is people are always thinking of, I want to be long something, or I want to be short it, right? That's very two-dimensional thinking. Or I want to be, I think X is going to happen. The market is going to go up, or the thing is going to, volatility is going to go up, or volatility is going to go down. None of these things are two-dimensional, right? They are all probabilistic distributions of outcomes. And each asset is itself, related to every other asset in different ways. So you really have to think big picture. So when you ask me what's going to happen to volatility, I think we have proxies for what's happened in past times. Some of that is relevant in the sense that market dynamics do tie up to monetary policy and the big trends that are happening during these cycles and fiscal policy. But there's also new things that are different. Market structure is different. The derivatives and options and that space is so much bigger and has knock-on effects that are very different. So if you put all these together, and we think about volatility broadly, the most important thing I can tell you is we've come from a period of Federal Reserve dominance. Interest rates started at 20% in 1982 and declined linearly. You could draw a straight line for 40 years. And people can often confuse correlation for causation. 40 years is so long. Nobody looks at a track record longer than 5 years, never mind 10 years, 20 years, like 40 years. For most people, they're so zoomed in that they don't understand that interest rates decreasing from 20 to 0 in a straight line has been a major, major force to the environment that we've lived in. It's actually the most important thing. I really mean the most important thing that's happened for the last 40 years. And it's like the silent hand that has massively affected everybody's life, and people have no idea why or how. But that Federal Reserve monetary policy dominance, the ability to keep coming in with supply side economics, lowering interest rates, doing QE eventually, all of that money flows. That was the primary tool of government to manage economic cycles and run liquidity in the market. That stimulus always being in that way means that money was going to the top every time. And it was a very supply side, meaning going to corporations, the ones supplying goods, the investors who are supplying the money to then invest and to create new things. It created a massive growth cycle, a technological boom. It created massive globalization. So what do corporations do? They're profit maximizing. It's all about incentives. You give money to corporations in mass. What happens? Much like the Mesozoic era, you put a bunch of oxygen in the environment. What happens? Dinosaurs get really big. It's not surprising. You send a bunch of money to corporations. Every time you stimulate, corporations get big and they're profit maximizing. And that money flows to the lowest place, which is what was the cheapest place? It was China. It was overseas. So we've had massive globalization. We've had massive replace people with technology. We want to advance because we make more money if we do that. So technological boom. We could also create Amazons and Ubers and Teslas and not make money for 20 years in corporations, but the money was flowing to an extent that they could do that. They could focus on eyeballs and not money. So this whole cycle, which your generation has lived all the way through all this time, is all you know. But that is not the way of the world over 1,000 years, right? And you could argue, well, then why won't they just keep doing that? Why? I mean, if the Fed can do supply side economics, well, they could if they would, and if there weren't human beings in a system, it's actually optimal. It's kind of free market economics, which is basically what that is. Using free markets to distribute money pushes resources to the top. That's natural selection. That is survival of the fittest. Survival of the fittest means one entity survives and its progeny lives on and takes, and all the others die, right? Like that's, your mom and dad told you life's not fair, I'm sure. It's not at its core, right? It's not fair. But people live in a system, and we believe in ideals like fairness and justice and liberty and equality. And so if we believe in those and we prioritize those because we see each other as equals, then, at some point that inequality is a problem. And that's inefficient, right? To be clear. And it's okay to be inefficient, right? Fairness is inefficient. Equality is inefficient. It's the truth. And so at some point, politics matters. People matter. And a populist time frame, which your generation is amidst, because you have felt at the very core how unfair it has been to be left behind, ultimately means inflation. That ultimately means deglobalization, right? It means slowing down of technology, slowing down of supply side economics and sending money to people. It's a demand side economic model. And so without spending 30 minutes, the whole 30 minutes on that, the reality is that's where we are. And if you sit here and look at that in these type of timeframes, you have dramatically different. It's a different regime. We are no longer in the old regime, and everything everybody's looked at, all the models that have been built for the last 40 years are different. And if you look at the periods where this has happened, we have a period right before 1982, 1968 to 82 as a proxy. Again, things are different. There's a lot of different things. I don't want to sit here and say this is 1968 to 82, but we should probably look when number go up for interest rate, right? To speak in crypto.
Yeah, you're in, man. You're in. You're a cool guy. Way to go. You just got a whole bunch of crypto followers on next.
Yeah. When interest rate yields go up, right? At the end of the day, you have a very different outcome. And so if we study that period, 68 to 82, which I speak a lot about, what happened? Well, Stock market went nowhere, literally nowhere in nominal terms for 14 years, point to point where interest rates went up. And in real terms, because of massive inflation, that's nominal. It lost 67% of its value over 14 years. Again, that's a long time to not only not make money, but to lose money. And so the stock market was just one proxy. Obviously, if you were in bonds, you also got destroyed, because if you're in a 4% yielding bond 30 years out and it went to 20, that hurt a lot. Duration could be a problem. So now that doesn't mean everything lost. Gold did incredibly well, the best performing asset of that period. Very different than the last 40 years, right? Gold hasn't been a great investment for 40 years. And there's a lot of other, we could go through all the things that worked, but it's a different type of market. Instead of a passive secular rising tide lifting all ships because liquidity is flowing to all supply, right? It is a world where risk and understanding risk and managing risk matters, where certain assets have incredible volatility, where other assets have dramatically less volatility than we've seen. It is a disjointed market, not one where a time of one country versus another, as opposed to all countries uniting together for profit and whatnot. It is a rich versus poor. It is a commodity input versus output story. There are so many things, and so in periods like this, volatility goes up, but those are things like FX, interest rates, gold, Bitcoin. Volatility in these assets goes up during periods like this because they are less controlled by Federal Reserve dominance and its ability to control the whole thing at once. The Federal Reserve cannot control a system when there is two objectives: price stability and maximum employment, and those things are now conflict. They have been aligned because we were in a structurally deflationary period, and they could just stimulate against that deflation for literally 40 years. So different world, different types of volatility. It's not like all volatility is going up. For crypto investors, it likely will continue to be very heavy. Gold is increasing in its volatility. I think Bitcoin and gold are becoming more united and are going to be more similar assets over time. I think Bitcoin's gone from very much a tech growth story, which it was early on, to a preservation of capital story. And I think that was always going to be the case, just structurally. We can talk about the origins of Bitcoin and how it's like it is millennial gold. That's what it was created to be, and that's what it is becoming. At the end of the day, it exists much like gold because people believe in it. We can try and get into all kinds of other things, but that's the story of gold since the beginning of time.
So much to unpack here, Cem.
I know. 30 minutes is never enough.
I don't know how we're going to do this all in 30 minutes. You take a sip of your coffee. Okay. First thing I just want to, before I start unpacking and jumping into a few other things. So we've been in this regime for 40 years. Your belief is that we are now in a new regime. We started a new regime a few years ago. I just want to kind of understand the timing.
Yeah, I mean, it's not disjointed like there's a starting point and an ending point.
Yeah,
it's important to note that. If you really want to understand, I'll try and be quick. Is in 2009, 2010, we had a couple of things called Occupy Wall Street and the Tea Party. Those were the first kind of clues that populism was on the rise. It was a very young. This is millennials, 15 years ago or so, starting and expressing that angst. But there was not enough political power in that generation yet. Baby boomers were, there were more of them alive and more in political dominance. It took time. And several entities started realizing that this was happening. And they were good marketers, and they realized, well, there's people respond to incentives. If people will vote for that policy, eventually it comes to the top. And so slowly, and this is a global phenomenon, to be clear, because the because the monetary policy regime and everything that the U.S. projected has become global. And so that's when it really started to happen. But it was it needed to gain steam, and it started with change in Obama, right? That's what that was. That was the beginning of the system. System isn't fair. It was more hopeful at that point, because now it's grown to be like, we need change, and I keep being lied to, and it's not happening. So now we want to burn it down, right? And so it's become more vitriolic and angry, which is, again, shouldn't be surprising, but it speaks to that generational angst.
And Trump having all the tech CEOs, some are Mark Zuckerberg, who I think is a millennial or maybe an old millennial, up there on his inauguration day. Like, you talk about the change in political power, like no better indication of it than that, right?
Absolutely.
Like, it is happening right before our eyes. When we look at like these longer time frames, there seems to be the view that I hear a lot on our show is that this current regime is still going to continue for another unknown how long, but there seems to be 2030 often gets thrown out there as, hey, we've still got another 4 to 8 years of this Fed control. But what I'm hearing you say is that they might be done with their ability to control it, and we are now into a new regime. Is that am I characterizing that correctly?
Yeah, I mean, it's happening, right? We've had, again, we were very vocal about this 4 or 5 years ago. Do you remember transitory inflation? That was 3 years ago, and that was transitory 1.0. And then we had transitory inflation 2.0, and then we've had 3.0. I think we're on 4.0 at this point, where the Fed says inflation's over. We're gonna cut. And then every time CPI comes out hot, and every time unemployment spikes back up, it's not a coincidence. It's not going away. It's secular. Honestly, the Fed knows that. The reason they're calling it transitory is because there's a reflexive machine where if people start to believe inflation is secular, then the cycle really accelerates, and that's where we're heading. It's not. It doesn't go in a straight line. It kind of picks up steam, and we kind of bump along. We'll have a period where we will have kind of along the way recessions. To be clear, that happened to the 60s and 70s, and then rates will come down. Just the next spike will be higher, and so there's a structural inflationary push, and at the end of the day, this is not, in my opinion, going to, and this is how markets work, not going in a straight line, but also not going to end in 4, 5, 6 years. This is, again, a generational thing. A generation is 20 to 25 years. And if we really started this, in 2010 type things, we got till probably 30, 35 at least. And it can be a little shorter. It can be a little bit longer based on intermediaries coming in. If we push out the policy that people want and go for more supply side policy again, which there are clues that, despite selling populism, that Trump might be doing some of the opposite, and the corporate interests are going to continue to try and push that, then we're just going to push it out for a while, and we're going to create a more vitriolic, more angry, burn it down system, and it'll take a different path. But those pressures are not going away until they are addressed. And A, they're addressed, but B, the generation grows older and is in a better spot to be more okay. They become they go from being labor. Again, I have to remember the reason it's a generational thing. The wealth inequality is because when you leave high school or college, you are labor. Like, generationally, you are labor, and when you retire, you are capital. And so this generational divide it mimics the stratification in society. So some of it's just a function of time. Now, whether or not this gets addressed is only part of the story. The other part is, at some point, everybody who's angry will no longer be labor. They may not make as much as baby boomers did or get to that point, but they will, at some point, will retire and be capital and have other incentives other than catching up. So anyway, but point is, yeah, I see this as a longer time frame than that. I do think we are, call it, I think the real impetus, if I was to say, was COVID kind of released things that changed the path that was coming, but it accelerated accelerated the trends. It accelerated a lot of trends, as we know, right? But I think that was an important event. We've had other. This is how cycles work. They don't go in a straight line. It's like Tinder is there and the incentives are there and everything's building, and then something happens. And often we have no idea what it is, and we'll attribute it to that, or that's the starting point. But it really is a release or a acceleration of like a spark that lights up what was already there. In the 60s, that was Kennedy's assassination. That's what led to LBJ passing the Great Society program. But the populism was already there. That's what brought Kennedy to his presidency. It was anyway. So my point is, the path can change, and there are cycles within cycles, and we have to zoom in and zoom out. But the bigger ones are easier to understand. The incentives are there. In between there, you have personalities and you have other forces within the system that push things in one way or another. But those you're able to predict by understanding what those machinations of the entities with power in the context of that are doing.
If we zoom in for a second, we've been chatting about the Fed. They held interest rates earlier this week. Looks like the next announcement we'll have, the next meeting they have is in March. Market is calling for them to continue to hold. And we have Trump announcing tariffs on Canada and Mexico. We've got China and some geopolitical risk coming, and some trade wars between, growing trade wars as Trump announces more tariffs. How do you sort of capture all of this, and what do you think matters most in impacting markets, or what are you watching closely as you think about the current, like this week, what happened?
Yeah, I think of things very mechanically. My father's a PhD structural engineer. My mother's an engineer. I went to study engineering at Rice and then eventually converted to finance. So everything's a machine for me. So it's inputs and outputs. There are other ways to think about these things. But in my mind, liquidity and supply and demand is a machine. It's like we call it liquidity, right? It's like waters in a pipe, and pressures pushing on one another, and that's the key focus in the short term. It's supply and demand, right? You've heard Benjamin Graham say, the short term markets are a voting machine, and the long term they're a weighing machine. Weighing machine is just weighing, right? There's a lot of big picture things, but in the short term, it's those pipes, it's that liquidity. So supply and demand, if we're trying to predict where we go in the next 3, 6, 9 months, a year, which, I think are the crumbs that your listeners really are trying to pick up on, because the long term is harder to trade. There's a couple important things. So one, and things are becoming clear, like under a new administration every day, and that's very important, right? Last year was easy. We knew what the incentives were already. We knew where things were going in terms of those supply and demand factors. So what's becoming clear, with still some opaqueness, is that, first of all, what do we know? We know that we're about 4 years from the low in interest rates, in terms of long-term interest rates. Time is such a critical thing. If I have one recommendation, just think more about time, not just direction. That 4 years means we are having we have a bit of a cliff. We have an accelerating need. People who are sitting at a venture capital firm or a private equity firm, or have a real estate firm that needs to refinance, or just individuals who need to refinance, who didn't lock it in for 20 years, but instead did 5, right? All of them are sitting there and starting to get a little more nervous. And they're nervous because they know they probably can't afford the new rate. If they're a person, as a private equity firm, they know that's going to cause them big problems if rates don't come down. If they're a venture capital firm, they're going to go, or a venture investment, they're going to have a major problem. And but they have to come back to market at some point. And that's supply. And that's overarching supply that exists out there. There's a lag. When people talk about the lag to monetary policy, all these factors I'm telling you about interest rate matter, but they don't matter. It's not like interest rates, which I always find funny. When the Fed announces a change in the Fed funds rate, people automatically assume like that move should directly affect what that's going to happen. what matters is the long-term 10-year kind of financing rate and how and whether it stays higher for longer. Because if it stays higher for longer and this is truly secular, like I believe it is, and I've been saying, then they can't just sequester the non-mark-to-market stuff into a corner and forget about it. They can't just not worry about the refinancing because eventually it will come. And so that's coming. And probably due about middle of 2026, and coming starting to come well before that, or middle of this year even.
That's what we've been talking about. Middle of this year seems to be when that will start to
That's
come.
when it will start, right? I agree, and it will start because if they don't do it by the last year, they have to.
They have to. They have no choice, right? Yeah.
And the market understands that, and other people are seeing this, and so again, all the more reason why it won't wait till that moment to have issues. Now, outside of that, just liquidity overhang, there's a lot of loss of momentum in a lot of the liquidity that's been put into the market already. And the Fed, which projected liquidity late last year, right? Much like it did the December before, which has become a trend. I don't think that's a coincidence, trying to pump and project for the spring, but did so much less successfully this December, has now paused again. And without the sufficient need or pump and momentum that's needed. And the system is reflexive. When we talk about liquidity, the other big input is not as linear in terms of like people are coming with supply or people like the Fed is stimulating, creating demand. It's a reflexive market thing. And so if markets continue to go up, they were up 23% last year, 25-ish% the year before, that's created a massive amount of liquidity to the system. And liquidity begets more liquidity. It's a momentum game. I've said this on other places, but I really want people to absorb this and understand the biggest provider for liquidity on the planet is not the Federal Reserve. It's financial markets. It's the equity market. Now the Fed can control the financial markets, and anytime Powell says we don't look at markets, we don't control, we don't not our okay. You control liquidity and you try and control the volatility of those markets, which they'll admit, but they have, but they don't control the biggest driver. They don't try and control the biggest driver of now, the way they do it is not as much. Yes, they use QE and they do things along those lines, which are direct plays into that. But more importantly, it's what they say and moving, interest rates, moving the market with what they say. That is the most critical tool that they have. And with a $100 trillion, 100 trillion with a T equity market globally, with another $100 trillion of private equity and real estate, other things that are tied to that market, you have a $200 trillion thing that moves up and down, right? If it goes up 10%, 200 trillion, it's $20 trillion of new liquidity. And if it goes down, you lose $20 trillion of liquidity. People always talk about how the market must be so efficient, forward thinking, because it always seems to predict the recessions that are coming. It causes, let's be clear, the recessions that come. It is not forward thinking. It's not like the market's smart. It is reflexive. It leads recessions because it causes recessions. It's not the only cause, but it is it's the one thing that can make us avoid recessions and continue things going on, or take weakness and then project it through the whole economy. And so, so that's the other important thing you have to think about. And if we're flagging and momentum is starting to fade, and this is why tops are a process, because if that liquidity stops coming and stops feeding the system as other supply is coming on, what happens when the market goes down? And not down for like a week or two, but down for a year, 2 years. Then what, right? We just had a massive stimulus. And valuations are rich because we've had a rally of 50% in 2 years. People are long, and a household exposure to equities is the highest it's ever been. So you tell me what the odds are. You draw your own probability distributions. Now it's reflexive. If the Fed can manage to get the market going again, and if it's aggressive early on, we can avoid a downturn. They can get ahead of this. It's possible. But a lot of things are going to need to go right. And I want to be clear, if they do and the market goes up and then it's 20% higher or 10, 15% higher, and then that need to refinance comes in, and then, then what? So there's, you can start to draw probabilities and likelihoods based on that. And then you can go more micro from there and start to look at flows on a more short-term basis. And Federal Reserve actions that Fed making yesterday was very important because it projected, in my opinion, weakness in terms of liquidity preservation. It was not proactive. That's not a great thing for the bulls. It doesn't mean we're going to crash tomorrow, or that, and there's monthly expiration cycles and flows and end of the month. This is end of the month, beginning of the month, which are also good, and an up month, which is also reflexive. So you have all these flows that come on a daily, weekly, expiration cycle, all these bases that really matter for day-to-day prediction. But if we're starting to talk about bigger liquidity and what matters for months, quarters, year, there's an overhang, and if we can't seem to get going here, that is a dangerous situation for this market.
Mm-hmm. And I want to wrap up here because I don't want to take up too much of your time, and I know you got to jump to another show because you're always on shows. So if we look at this, where we're at now is if you're a bull, things could go well this year, as you said, if the right ingredients kind of line up and all come to the table at once. And certainly Trump is going to push for that. And
right.
He's
That's actually,
a market guy.
Let me jump in here. I completely agree with that. Like the big question mark has been since the beginning of this year, and this is why we're watching so closely. And I'm sorry to interrupt, but the pairing of Elon, right, and the the tech kind of cadre that is corporations that are now tied to Trump. And if anybody understands this momentum game, squeezing calls and pushing things, I mean, he literally created Tesla on the back of that. A lot of people wouldn't agree, but Tesla very well may not have stuck around or been able to make it through some really tough periods if he wasn't able to push manipulate, for lack of a better term, the price higher and really squeeze it higher to help provide. Again, markets are the biggest liquidity machine. He created liquidity for his corporation by doing this. He understands these things, and so do the people in power. So, to bet against this market is to bet against their ability to be proactive enough to do that again. So it's always a dangerous, particularly in a world where you have a market-driven group of people who are focused on the market. So again, a word of caution to those that are just trying to short this out, right? But price matters at this point, and the movement of the underlying to create liquidity for the system matters. And if it can't, it's not a good situation, is what I'm saying. But they may very well be able to do it.
It's going to be an interesting thing to watch and to see. And I think comes back to sort of where we started this episode is it's why we are in this state of market volatility where, things are going up. There's been number go up, as you said, for a few years here. Can we continue to do that? Maybe. But there's also that maybe not to scare the shit out of everybody. I think I said at the beginning of this episode that we would give you some calm. I don't know if we've achieved that here today. Any final thoughts to share before we let you go, Cem?
Yeah, I'll say to that point, let's end with a moment of calm. Risk, right? And volatility doesn't have to be stressful. It actually is. You're able in this day and age to manage risk and volatility very precisely in markets by using options, by using multidimensional kind of parts of the distribution, not just up down. And if we are now thinking about, as I've laid out, the distribution of outcomes, there are great opportunities to both, remain invested and find ways to make money without crawling in a hole, right? And still manage your risk appropriately. The key is to be proactive and not reactionary. Volatility is your friend. It's actually it allows for opportunity, but only if you're prepared and not just playing number go up, number go down. So I think you'll find volatility traders, option traders, to not be volatile themselves. There's a sense of peace and calm and knowing and understanding the dimensionality of the world and how to manage that. So I'll leave you with that.
So enjoy the ride is what you need to do, because we're all in it, and it's going to continue no matter what, one way or the other. Cem, thank you so much for your time today. We greatly appreciate it. It's been a pleasure.
It's been a pleasure. Thanks for having me.
Thanks for listening in, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.